Affording a home right now is tough in the US. Prices are high, interest rates have soared, and for many buyers and for many renters, the dream of home ownership feels a little bit out of reach right now. Here's the thing, that doesn't have to be the case. There are some incredible tools out there that I'm going to share with you that have the potential and will actually reduce the amount of money you need to purchase a home by 20% and will reduce your monthly payment by 20%. We're going to go through them in detail, and I'm going to show you a side by side comparison of how you can use these tools called temporary and permanent buydowns. And whether you're a buyer looking to lower your monthly payment or reduce your cash to close, or whether you're a seller that wants to make your home stand out and appeal to more buyers and help more buyers qualify to buy your home, or even if you're a lender or a real estate agent trying to help a buyer or a borrower get into a home right now, you're going to find that these tools are incredibly helpful. Now, this is the Don Harkins Real Estate Show. I'm your host, Don Harkins. We're here to help consumers, realtors, lenders, and property managers navigate the complex world of real estate. We're going to uncover deceptions, misconceptions propagated by some of the most well-known names in the real estate industry. We're going to look at myths and tactics that unfairly target consumers and real estate practitioners. We're going to cover topics from introduction to real estate investing, negotiation secrets, marketing for brokers and agents, property management fundamentals, and how AI is transforming real estate. My journey began after graduating FSU with a Bachelor of Science degree. I served as a firefighter paramedic for 5 years, and during that time, my passion for real estate was ignited after reading Robert Kiyosaki's Rich Dad, Poor Dad. That inspiration led me to pursue a career in real estate, starting with selling homes, primarily investment properties and bank-owned homes after the 2008 mortgage crisis. Today, I own 2 real estate brokerages, one focused on traditional sales and purchases in Central Florida on the Space Coast, and another specializing in long-term property management for absentee owners. I'm also a licensed mortgage originator, and that's where we're drawing on a lot of today's information from. It doesn't take a lot of research to see here Americans recognize housing affordability crisis from americanprogress.org. This is a simple search I did on Google for housing affordability trouble. National Low Income Housing Coalition. They say that record-breaking numbers of families cannot afford a decent place to call home. The Pew Research Center says 31.3% of American households were cost burdened in 2023. JP Morgan talking about Florida's affordable housing crisis all the way back in August 2024. On and on and on. Harvard Business Review, EconoFact. I mean, the headlines are everywhere. And the thing is, this is not getting better, right? This is a unique situation with housing where typically when homes are expensive and buyers can't afford to buy them, the homes on the market kind of stack up and housing inventory grows and inventory grows and grows and grows and demand falls as inventory grows and prices can float back down. What's unique about this time in housing is that as buyers leave the market due to affordability challenges, sellers are also keeping their homes off the market. Every time the interest rate goes up and 3 buyers leave the market, 3 sellers decide not to list and move as well. So as home prices and interest rates rise and rise and rise, we're not seeing that growth in inventory that typically allows demand to fall and prices to float back down. And it doesn't look like there's any end in sight to this. So we have to look to other ways to solve housing affordability challenges. Starting with what's available in the market, I looked at the homes that recently sold in the last 7 days, and I picked a price range between $490 and $510. This is a lot of single-family homes, wide range of availability. And in the last 7 days, there were a total of 56 properties in this particular MLS that sold. And out of those 56 properties, one thing that I noticed is more than half of them, or nearly half of them, 27, included seller credits. And in addition to that, those 56 homes sold on average for 4% below their listing price. So we have homes selling 4% below their listing price, and we have about half of all homes including seller credits, which are different than below listing price, right? So these homes are selling below listing price and they have seller credits. So if I go here and I say, okay, I've got 27 homes that included seller credits, and I want to look at those 27 homes specifically and say, if I want to get credits and I want to buy a home below listing price, how much is a seller willing to negotiate with me if they're also giving me a credit? The answer is not quite as much, right? Median home price, 99% when credits are included. Average, 98% when credits are included. Okay, so let's look at the amount of credits that were included. When we look up and down this list of 29 homes that sold in the last 7 days and included seller credits, the average seller credits were a meaningful amount. On average, sellers were paying $12,000 in credits to buyers. And so at this sale price, we know $12,000 is roughly 2.5%. So we have 2.5% credits that we can play with. And we also have about 2% in sale price reduction we can play with. So if I'm a buyer out looking at homes today, I can safely assume I've got about 4% that I can work one way or the other. And that's going to be important when we look at affordability and solving affordability with 4% of sellers willing to give us. This right here is a buy down calculator. We're going to be looking at this amount here as credits, right? That 4% amount, or roughly $20,000. Real quick, the way we got here, this is looking back at the last 6 months, mortgage-backed security prices, or if you prefer to look at the rate, we can see over the last 6 months. And if you bought in August or if you bought in September, you're probably looking at a 6.5, maybe even a 6.1% rate. And here we are just 4, 5, 6 months later, and we're looking at rates in the 7% range. So for our example today on how you can save massive amount of money, reduce your down payment, reduce your monthly payment by 20%, we're going to be looking at rates in this range, real world rates in this range. So what we're looking at today is 3 scenarios. And this 4th scenario, we'll talk about at the end. But in these 3 scenarios, a couple things are the same. Purchase price is the same across the board. The loan amount will vary some. The interest rate is going to vary quite a bit. The term is not going to vary at all. Term's going to be the same. And the payment's going to vary quite a bit. But what's interesting and what you should pay attention to is the cash to close stays relatively the same. So how do you buy a house for the same price, put the same amount of money down, but have a payment that varies so widely? In this case, $3,600 to $2,900, or even $3,600 to $3,200. The way that you do that is utilizing buydowns, permanent buydowns versus temporary buydowns. So a permanent buydown stays with the property for the life of the loan. And this is quite simply just paying points to buy the rate down. So in this particular scenario, the permanent buydown, let's just compare these 2 columns right now. We're looking at a 7.3% interest rate versus a 5.4% interest rate. This scenario is not going to save you cash to close. Okay, you're paying the same amount to close regardless. You're putting a little bit more down in this scenario, and you're putting 10% down in this scenario. Okay, what we're looking at is how do we apply $20,000 in credits to get a reduction in our payment? And so when we look right here, just between these 2 scenarios, the permanent buydown is going to save us $437 a month. And the cost of that, when we go down and we look at the fee detail sheet here, we can see there's a total cost of $20,700 to buy that rate down. Okay, so I've got 2 options. I have a total of $86,000 to spend, and I'm buying my $500,000 house. I can spend that $86,000 total, and I can spend it and get a payment of $3,643, or I can spend it and get a payment of $3,205. All right, huge difference. If we look at savings over time, you really get a large savings, especially over 15 years. You know, you're really paying interest and mortgage insurance By buying that rate down, you're saving about $110,000 over just the first 15 years. So you can pay the loan off a lot quicker. So, first of all, look at the total amount of money you have to spend. Look at your budget and decide, do I just want to put as much down as possible to get a lower payment? Or should I put a strategic amount down and then utilize some of the other money to pay points? In this case, you would be saving about $437 a month. So that's a permanent buy down. You get this rate, you get 5.4% for the life of the loan. Okay, so 15 years, 20, 25 years down the road, you still have your 5.4% rate. Pretty fantastic. What's interesting is when you look over here, it's like, well, this looks pretty good. This doesn't look so great, $3,600 a month, but $3,200 looks better. $2,900 looks a lot better. $2,921 a month. So how do I get $2,921 a month for my payment, putting the same amount of money down? And that's using this temporary buy down, a 3-2-1 buy down. And so you can see what happens here is this rate, instead of it being 7.375%, it's 4.375%. And you can look here, the first 12 months of the loan, your payment amount, $2,321.99. Okay, so this $2,300, this is your taxes and insurance built into these payments here. So these are total payments. But when we just want to investigate what this 3-2-1 buy down actually gets us, what it gets you is a payment for the first 12 months of $2,300 a month. The next 12 months, interest rate goes up to 5.375%. Your payment goes up to $2,595 a month without taxes and insurance. The third month, your payment goes up to $2,882 a month. And then at the end, your payment resets to the full regular payment at 7.375%. So who should utilize this particular strategy of saving $721 a month with a 3-2-1 buy down? And we made some assumptions here, I should tell you, right? Anytime we're looking at mortgage financing, we have to consider factors like credit score, down payment amount, property location, loan type, amount of reserves, debt to income ratio. All these factors go into your loan. So the scenarios that I'm showing you here today are not necessarily for you. Your numbers may be lower or higher. You may be saving a little bit more or a little bit less, but we have to pick a generic buyer for a line in the sand to compare apples to apples, right? So what we're looking at here is a credit score of 740. We're looking at someone that makes $120,000 a year, that only has $1,000 a month in monthly debt outside of their mortgage. Just a pretty vanilla borrower, generic borrower for purposes of comparison. But when we look at that, you can see, wow, this house, that a $500,000 house I thought was going to cost me $3,700 a month, I can get into it for $2,900 a month, and it costs me the same amount of money as the person paying $3,600 a month. Now, what happens if interest rates continue to go up and continue to go up and continue to go up? Well, if that happens, then eventually you're going to be at whatever today's rates are, 7.375%. Month 37, you're paying 7.375%. So hopefully you're getting pay raises, you're saving more money, you're putting yourself in a position to be able to afford that payment. If rates go down, then what's going to happen more than likely is you're going to wind up, maybe you pay your 12 months of your $2,300 payment, and maybe you pay 6 or even 12 months of your $2,500 payment. But with any good fortune, as inflation starts to cool and come down, if it does, and if your belief is that it will, somewhere maybe in between month 24 and month 36, you'll have an opportunity to refinance into a permanently lower rate at a cost maybe much less than what you could pay to get into that rate today. So you could potentially enjoy a monthly savings for 12, 24 months and then pick a better opportunity to refinance down the road. So while this payment looks good, this one looks even better, right? If you can save $720 a month or save $743 a month, $743 a month sounds even better. And what's unique about this column right here is the cash to close is also reduced substantially from 86,000 to 72,000. So, how do you structure a deal where you've got a monthly savings of $743 and a cash to close reduction of $14,000, roughly 20, almost 20% cash to close reduction? The way you do that is by using some seller paid concessions. So when we hop in here and we start to look at our closing costs in this column over here, we haven't talked about seller concessions at all, but you can see here there's some seller concessions built in, $13,000 of seller concessions, and that is a 3% contribution from the seller. That's a maximum allowed in conventional financing. So you're actually taking advantage of these market conditions that we looked at, and you're saying, okay, well, if I can get 98% of list price, instead of negotiating the price, let me offer full price. And then on top of that, I know that with most of these houses, if I go back and I look, I can see, okay, the seller's paying some money at closing on these, and that's not reflected in the sale price. So you see these seller credits here. So the way to save the most amount of money and to get in the home for the lowest monthly payment would be to offer full price, negotiate a seller paid credit to use towards an interest rate buy down, max allowed for conventional loan 3%, and then don't leave that extra 1% on the table. You know, come in 1% under asking price. So instead of offering $500,000, I'm offering $495,000. So by negotiating a little bit on the price and taking the full credit, I'm able to reduce my cash to close and still wind up with a payment that is $743, at least for the first 12 months, lower than what I would be paying if I was utilizing a conventional loan. So, in summary, this is one of numerous examples of different tools that are available in the marketplace if you're working with a real estate agent and if you're working with a lender that knows how to be creative. And when I say creative, these are very middle of the road, major national lenders and wholesale investors that offer these programs. This is not going off to Jimmy the loan shark and getting some out of the box, risky, high interest, early prepayment penalty type of loan. This is not that type of thing at all. This is very legal, middle of the runway type of strategy that's available to the vast majority, or at least many borrowers, if you are working with someone that knows how to investigate and be creative, both with the offer strategy with the seller and with the loan strategy on the lending side. Hopefully, you can take away from this that there's an opportunity for you if your house is too small or if your house is too big and you feel like you're trapped in the home. Hopefully, you can take away that you have some options available to you, or you may have options available to you that you haven't considered. If you're a real estate agent and you've got a listing that's not selling, instead of just throwing a price reduction out there, consider using seller paid concessions to alleviate affordability challenges with buyers and expand your buyer pool. And if you're a lender out there and you don't have these options available to you where you're working, you're going to struggle to convert buyers and borrowers into homeowners because you're limited in your ability to alleviate these high payments. If you have any questions about anything we talked about today, I'd love it if you would drop a comment or send me a DM. If you're listening on Apple or Spotify, please leave us a review. It would be great to know who's out there listening. We'll definitely read them all. If you're watching on YouTube, please like and subscribe and consider sharing this channel. If you find any of this information helpful, we'd love to hear it in the comments. And if you live in Florida or you're thinking about purchasing or selling a home in Florida or getting a new mortgage, or if you have a rental property that's been problematic and you can't keep a tenant in place or can't get rents up, we can solve all those challenges for you, or at least be another good option. So reach out today. I'm Don Harkins, and thanks for watching. Take care.